How to buy stocks. Lesson 4. What's a good price? Now that you know how to choose a good stock, you want to know whether the current price of a stock is a good price. We're going to talk about the different factors that go into the price of a stock, and then about how to decipher the price to see if it is a good price to buy the stock. These factors are historical prices of the stock, the outlook of the economy, and the future outlook of the stock. As the previous slide mentioned, an important factor is historical prices of a stock. Yahoo Finance has an excellent tool in order to be able to look up historical prices of an individual stock, and they will give you that data in a daily range, a weekly range, or even a monthly range, depending on how far back you want to get this data. So this is extremely helpful in trying to figure out what the 5-year trending price is of a particular stock. So, getting right into it as far as looking at a particular stock, say you pull up Yahoo Finance and you get, say, 2 years worth of data, or even the last few months of data, just like this. And the current price of the stock is trading at about $23, but its usual price is actually trending at about $35 or $40. Now that is a very good thing in most situations unless the company isn't doing very well. But if you're following a company that is very stable and very reliable, then looking at a stock from this perspective can really help you. Because if you follow a stock and you know that it is very reliable and that it's usually around 40, and then say the economy dips a little bit and stocks drop, there's usually a price that you can really get a feeling that this will not go any lower than X dollars. And in this case, you can see that it's really almost getting to that $20 mark. So it's almost like the stock can't go any lower than 20. So 23 may be a really good price before it starts going back up. So this is a really good way to look at a stock and say, maybe if I buy it at 23, it has the potential to, at the very least, get back up to $35 to $40. So if you buy enough shares at $23, which isn't too expensive, this can be a very good, safe investment. Now, you definitely have to do your homework on that particular stock to make sure that it's not trending down for, some different reason of a lawsuit, or, they're having, problems reporting their numbers and everything. So like I said, as long as it's a reliable company and their trend is to typically around $35, $40, then this can be a good thing. The one caveat to doing this type of analysis is you have to understand what a stock split is. And basically, this is a stock split example where the stock is typically at $60, but now it's split into $30. Now, stock splits are great, especially if you already own the stock. Basically, they redistribute all the shares, so you get double the amount of shares, but at half the price. So you don't lose or gain any money, but you do gain double the shares. So if it starts to go up again to say $30 to $40, now you're making double your money on each time that goes up $1. But when you're doing analysis, it's important to look at this, because you don't want to say, okay, well, typically it's trading at $50 to $60, now it's down to 30, so it's going to get back up to 60 now. You have to be aware that that was a stock split, and that typically when a stock splits, it takes a lot longer to get back up to its highest stock price, if it ever does. But it can be a really good investment, because if it's a very good company, they basically split because they want to grow their shares, they want to keep interest, because if it gets too high, then people will stop investing in it because they can't afford it. So it's a great way to get more people to invest in your company at a lower rate, and then it can just keep growing so that you can make even more money. So it is a good thing to look at potentially, but you have to be aware of the potential gains might not be as high if you're just getting this stock. So that's something to be aware of. The last few slides mentioned why a stock may be trending lower, even if the company is doing well. And that's where the economic outlook comes into play. Even if a company's numbers are strong, investors' confidence in the economy and stock market as a whole may be down. As Lesson 2 demonstrated, the economy and the stock market are directly correlated. That lesson went over the general flow of the economy, but to drill down a little deeper, let's go over some of the key indicators of the economy. The unemployment rate can show the health of businesses and whether companies are hiring due to economic growth or laying people off due to a lack of economic and business growth. Taxes are another important thing that affect the economy and the stock market, because when businesses are unsure of what the tax policies are going to be when they come out of Washington, they tend to wait on hiring and hold on to their cash. So this becomes important when presidents have dates of their taxes that they're going to expire at. When businesses really have no idea whether they're just going to extend those taxes or if they're going to change the taxes, businesses tend to get worried, and it tends to stagnate the growth of those businesses, and that therefore affects the stock market and investors investing in their companies. So that is something very important to look at. Inflation is another factor that is constantly being watched by the Federal Reserve. And it's a very interesting to look at because the Federal Reserve tends to print money in order to inject more growth into the economy so that there's more credit available for businesses to invest and to borrow from the federal government. But the problem with that is if they do it for too long, now there's too many dollars in the system and there's way too much supply and not as much demand for dollars. So they do it to help the economy in a short term, but if they're doing it for a long period of time, then it can be a serious problem, especially when it comes to investors and investing in businesses where their dollar isn't going as far due to inflation. So another thing tied into the government is government debt. And that tends to worry investors because if the U.S. can't pay their bills, then the whole system will collapse. So this is very important with U.S. Treasury bonds because other countries and not just Americans buy U.S. Treasury bonds. So different countries like China own a certain percentage of the U.S. because of the number of U.S. Treasury bonds that they own. So that's basically us borrowing money from China and then paying interest on those bonds. So China can be very concerned if there's ever any instability in the U.S. government in paying the interest on those bonds. So that's a very important factor to look at because it can cause a lot of concern in investors, and they don't know what to do if we have too much debt and we can't afford to pay all of our interest on our bonds or any of our bills. And one other factor to look at which can be very helpful is home prices. If home prices in your area or around the country are rising, that can be a very good thing because it means that people are out spending money. It means that they have enough money in order to buy houses, which is going to rise the price of everything. And the more money you have in your house, the more equity you have. It means that you have more to your name, which can be then another catalyst for investing in the stock market or in other businesses. So home prices are very important because if they continue to trend upwards, it's a good thing for the economy and for the stock market as a whole. So these are very helpful indicators to really understand why the stock market is either doing so well or so poorly because of all the different factors that come into play based on what our government is doing for us or isn't doing for us. The last thing that I'm going to cover is the future outlook of a stock. And this can be very helpful, but should also be used in combination with another research tool like the price trending analysis and a few other factors. Now, advanced stock analysis is outside the scope of this course, but that's why we're trying to just get your feet wet and help you just figure out, when I look at a price of a stock, what is a decent price, or can this even be bought at this price? So a really quick, easy way to figure out what is a good price, which is the name of this video, is essentially, once again, use Yahoo and go and look up a stock. And one of the first things they give you in their key statistics is the 1-year target estimate for this price. And that is very helpful because you can see what the price is currently. So in this situation, this is Pepsi, just used as an example, and it's trending at $73, but its 1-year estimated target is 76. So it really helps you make a decision as far as like, all right, I think that there is potential for this to go up. Whereas if you looked at it and it said 73 and the 1-year target is 71, it's already eclipsed its 1-year target. So you have to try to figure out, do I really think that this is going to go a lot higher, or is it only going to go lower from here because it already hit its target and people are realizing that they're overvaluing the stock? So to kind of help with the range as well, you have a 52-week range on the right side to see, wow, it was as low as 62 and it's at 73 right now, so there's some wiggle room. But a lot of times it's good to look at targets of around $5 to $10 estimates. That way you know that it at least has the potential to go a lot higher and that the current price is potentially being undervalued. And a good thing to go over right now is the fact that the reason that we're looking at the prices individually is because it's really difficult to look at two competitors' prices and put them hand in hand or side by side, because depending on the size of the company, depending on a ton of different factors, is why the prices can be so skewed and so different. But the price isn't really a good indicator exactly of how well a stock is doing just because it's really cheap or really expensive. So you just want to take the price for what it is and mark it against the 1-year estimate, sometimes its usual trending analysis that's happened in the past, but also a little bit mostly a weight on the future to see where you think it's going. So that's pretty much it and the basis of this video. Like I mentioned, it's really good to help you get your feet wet, whereas another course that we offer gets into a lot more number crunching and analysis, but this is really designed to just help you decide whether this is a good idea and just really help you figure out, looking at a price very quickly, I think this is a good price just based off of its price, and that's where you go from there. So thank you for watching this video, and please continue to the next video.